and others are on the way. They are in some chamber's office for some other meeting. They will be joining us shortly. I have a pleasant task of introducing Pradip Bhai, who is our regular speaker. Apart from the fact that he is a past president of the chamber and the BCA, he is our regular speaker as far as the study group is concerned. In spite of his extremely busy schedule, he always readily agrees to our request. I can definitely say he is one of the pillars as far as the study group is concerned. Very methodical, thorough on the subject. Today he has come on the pitch with the confidence that in the limited time also he will score half century. With this I present before you Pradip Bhai. Before I request Pradip Bhai to start the discussion, I will request Dinesh Bhai to offer a memento as mark of our love and remembrance. With this, I request Pradip Bhai to start the discussion. Yes.
Very well. Good evening to all of you. Chairman Ashok Sharma, it's always a pleasure, having him on your side, because he is the one, who would always question your decisions, say, and he is always ready and up to date, more than anybody else, so it's always pleasure to have him back. All of you are aware that he was the one who was very early leading this committee for that many years. Previous year, he had a break. Once again, he has, come back to this committee, and we welcome him back. We have now a new president, a very young president. Once he comes, we will talk about him. We have shortlisted several decisions, which some of it, to the extent possible, we will try to do justice in discussing them. There are about 48 of such decisions, which are too short of the half century which Ashok Sharma wants, and we have added 3 more, which by oversight, I missed welcome president and also the vice chairman of the committee. Yes, yeah, right. In fact, it's very good to do the honors, to welcome the president. Instead, normally it's other way around. Yeah, good. He is the one who keeps very extremely busy and very committed person, a dear friend of mine, and I wish him all the very best. Dilip, as usual, puts in very hard work, and for some reason, keeps away from the management, and I believe that that perhaps is the right thing to do. We wish him all the very best. With this, we would start with the first case which we have taken up is about. There is one more thing, before we start with the serious discussion. As I said, there are about 51 cases which, time permitting, we would at least touch upon them and try to do justice to them. Now, one would wonder that, after so many years of practice and after not thousands but 10,000s of cases, what is there new in this Income Tax Act, which runs into about 600 pages? Is it not that by this time all of us should have been very, very familiar, not just familiar, but very, very familiar with the provisions of the law, and perhaps there would not be anything coming out of the decisions which would in fact excite us. But as one would see that out of 51, almost 51 of them, there is some issue which is emerging out of it, at least to a person like me, who has limited abilities, one would feel that there is something which perhaps, could have been addressed differently, or something which one was not clear about, and it tries to throw a new dimension to what we are discussing. So coming to this once again, is the first case which we have taken up is, I have a perhaps a bad throat, and I would request you to bear with me to the extent possible. The first case which we are discussing is the one about he facts wherein the convertible warrants were issued, And in respect of some of the subscribers, the persons may not have later on subscribed to the balance part of the warrant consideration or warrant capital. And in that background of the case, a huge sum was forfeited by the company. The short issue for consideration was that whether this money which had been forfeited by the company represented an income. If yes, was it taxable or was it in the nature of a capital receipt and therefore not taxable? The simultaneous issue which was raised by the Income Tax Department was it covered by the provisions of Section 28 being part of a perquisite or benefit arising in the course of the exercise of the business or profession? These were the two major issues which were to be considered. In the past, we had several decisions, wherein a view had been clearly taken that when you forfeit an amount on account of an unsubscribed share capital, a call money was paid or even after the allotment was made, the balance installment of the share capital was not made. In such case, the courts were clear and unanimous in holding that the money which was to be received was on a capital account and therefore it will continue to retain the character of a capital receipt and therefore was not taxable. As compared to that, this to begin with, there was the difference. One was that to begin with, when the warrants were issued at the outset, they had a color of a debt, which at a later point of time were to be converted at the option of the persons who were subscribers to warrants. So it did not have an initial flavor or the color of the capital. That was one issue. The second is perhaps some of those decisions which had decided in favor of the capital non-taxation did not have the benefit of Section 28 subsection 4, which provided that perquisite or benefit arising in the course of business should it also be considered to be ground enough for taxing such receipt. After examining the overall law, the court came to conclusion importantly, that 28.4 did not have an application for the reason that 28.4 applied to a case of receipt of a perquisite or benefit which was received in kind and did not apply to the receipt in cash. And this warrant money being received in cash, 28.4 should not apply. So therefore, a fiction which could have brought this into the business taxation, business net, has been ruled out. And secondly, it was otherwise stated that this was not something wherein the company was in the business of issuing warrants, and therefore it should otherwise also not be treated as an income in the course of business. So therefore it did not have an income color, a business income color, and therefore should not be taxable. I do not find any dispute with this decision and one would welcome this decision. Of course, there are a couple of other decisions also on the similar lines, but I thought of sharing this with you. Sorry. Yeah, one small thing, so request is Ajay that yes, we would discuss to the point, yes, that if JB is arising out of it, we will surely deal with it. Right, okay, very well. I just... So what happens is in these cases that yes, that as we are discussing few other JB cases in the context of carbon credit, in the context of the discounting of sales tax deferral loans, in such cases whether JB would arise or not. So the same flavor would be here. As we would see, there is a conflict which we are likely to address, and then that will perhaps answer your question. Yes, yeah. What I was trying to say was that if the issue is emerging out of the four corners of this particular case, then we discuss. That's what I was trying to say. Okay, coming back to this, the other one is also a beautiful thing. It's about the carbon credit. Whether this money which you receive on account of the carbon credits, whether it is liable to be taxed as business income, alternatively can it be taxed as capital gains, and if not anything, can it be taxed as income from other sources. So all these issues were there, and like what Ajay said is that in this case the issue of book profit taxation also was there, which we will take it up independently. First, let's address that whether this carbon credit is a business income or not. Similarly, like the earlier case 28.4 also was brought in operation to try to tax this. Now three things which were noted by, because as we have agreed to deal with good number of cases, we'll skip the facts and touch upon the facts, and thereafter if somebody tells me, I will surely elaborate on them. What impressed the tribunal in deciding that this is not taxable was the tribunal noted that the carbon credit had an origin in the Kyoto Protocol, which was governed by the UN functions. Okay, carbon credit and the environment protection. So therefore, any businessman or otherwise also, anyone who was in the business of, who was trying to protect the environment was entitled to carbon credit subject to certain compliances. So therefore it noted that that it had apparently no origin. It had apparently no origin which was directly related to carrying on of a business. It was incidental that we were carrying on a business and therefore we were entitled to A. Second is, no matter whether you made profits or not, no matter whether you carried on a business in a particular fashion, what was significant was that you were entitled to carbon credit because you were instrumental in protecting the environment. So you were in fact carrying out not only a social cause but an international cause of protecting the environment, which in present days is considered to be one of the most vital consideration for the survival of many races, including the human race. And therefore it was considered that it had no direct nexus to the carrying on of business, it was incidental. Okay, right. And in that way of the matter, this amount could because it was received in cash, it was not a perquisite or a benefit. B, that it was unrelated, otherwise not directly related to the business, and therefore also it was not taxable. The third and the fourth factors are very noticeable, and they also provide us with effective tools of interpretation and further arguments in the courts of law. The third one was that it was explained to the court that that if had the government wanted to tax it, it would have provided for it. And the attention of the tribunal was brought to the provision of the direct tax code. Now, direct tax code has a specific provision for taxing this carbon credit as a business income. Failure to do so in the present Act of 1961 should also be considered as a tool of interpretation to understand the legislative mind and also the purpose behind this. Lastly, fourthly, it was also explained that please look into the provisions, the new provisions of section 28, especially 3A, 3B, 3C, 3D, 3E. All such provisions which had the effect of bringing to tax income receipts which were otherwise not taxable, like import entitlements and export incentives and such other things. So wherever the legislator wanted it, it had specifically provided for such things. In this way of the matter, lastly, relying on two other decisions, that is one of the Hyderabad Tribunal and two of the Chennai Tribunal, the tribunal came to conclusion that this was not taxable. The next decision which we will take up again, and these are decisions which had huge tax impacts, and that once again independently also impressed one that when we pick up the issues, they are of larger importances. The next issue is the case wherein are the cases of subvention. These are the cases wherein you come across a case of a company which is making losses or which is in the process of making losses, which is likely to make losses. Okay, and you feel that you have a feeling for that person, that company, because you are its parent or you are a holding company, and therefore in order to see that this traveling company is supported in some manner, you try to fund or assist or aid that company in some manner, which process is in the financial term is known as subvention. So in these cases, the parent company or the holding company, there are two cases, Siemens and the Deutsche Bank's case. In these both the cases, the parent company or the company came out to the rescue of the companies which either had made losses or were likely to make substantial losses. It was essential, please come. Yeah, it was essential to ensure the survival of this company for the parent and the holding company. And that way of the matter, substantial funds running into of rupees were pumped, subvention, and they were non-refundable funds. The issue that arose was that whether this money which the company had received was taxable, again 28 again independently, could it be considered in the course of business as long as they did not have the flavor or the character of a capital, nor were they loan, and by admission they were not refundable. And the beautiful arguments were canvassed even by the revenue side was that that what would happen if the grant from any government was received in the course of an aid. If you're carrying on business and then an attempt was made to equate it on the lines of Sani Steels or Pony Sugar Mills and such other cases, but PJ Chemicals, see what was the distinction between a capital subsidy and a revenue subsidy? Was it for the purposes of carrying on business and all such host of issues? It was a very well fought cases. Both were very well fought cases. The tribunal or these were the court cases. The court agreed that yes, that in such cases, this when a grant was received by the government agent from the government agency for the purposes of facilitating your business, for the purposes of minimizing your losses, then in that case it perhaps could have been taxed as an income. Howsoever, when a party which had some interest in your survival, which was related to you in some manner, this is a new line of argument, which was related to you in some manner, then in that case an ordinary treatment of this receipt to be taxed as income would not perhaps apply in such cases, because this otherwise were, if at all if it could be equated with, and some analogy was provided, it was more towards the gift than something else. It was more towards the gift, like a parent would support a child. So similarly, a holding company or a parent company would support a subsidiary company or a company in which it has interest. And by virtue of that, it should not be treated as a taxable income A. The second and perhaps also an important point which care was taken in one of the cases was that the subsidiary was on the verge of making losses but had not made the losses. And therefore it could not be considered, because one of the arguments was that isn't it a recoupment of the loss? If it is a recoupment loss of the loss, then what would have happened is that the loss which otherwise that company was entitled would have been reduced. And in that case, the benefit which would have been fully enjoyed by the subsidiary company may not have been enjoyed. The loss which otherwise was made, if the amount was paid to recoup that. See, we all are clear that any expenditure which is met by the third party, it is borne out by the third party. To that extent, your claim reduces to that extent, even in respect of depreciation also, your actual cost on account of several explanations to 43(1) gets down. Okay. So similarly, there was a possibility, while in this case, it was the case that the losses had not yet been made, had not been incurred, and therefore that also was a point which favored the assessee in deciding the issue. So these are the three cases which we talked about in the context of income. The next one which we will go about it, and that is where we would now take up the book profit issues, because book profit also is a case of a notional or a fictional income. So this is the case that whether this would be so. Let's take that carbon credit itself. Now carbon credit was a huge amount. Now they succeeded in ensuring that it was not taxable, a capital receipt. But that doesn't end there. If you are a company which otherwise is exposed to book profit taxation, then the immediate issue which arises for consideration is that whether it is liable to book profit tax, and if it is so, the government is happy. Instead of receiving 34%, it might perhaps receive 18 to 20%. Government still is not very unhappy on this account. But when the government is told, that also would not happen, then there is a problem. Now here, it is an admitted fact that the amount was credited to profit and loss account. For the purpose of limited presentation, we would not get into the argument that whether the amount was required to be credited to the profit and loss account, whether it was covered by Part 2 and Part 3 of Schedule 6 or not. We will not get into those aspects because those were not the issues which were raised. Now, so here the short issue was that, when the amount was credited to P&L account, should it not be treated as part of book profit? In computing the book profit, the company had taken care to exclude it from the net profit as per the profit and loss account. And the tribunal came to a conclusion that having once accepted the fact that this has no color of income, it can by no stretch of imagination either as income under 224 or otherwise as income under 115 JB, it could be so considered, and therefore should not be taxable. Well, there could seriously be another view possible. Howsoever, this is one view which has been taken, and therefore we will have to take it with a pinch of salt. As we will proceed, we will next case itself is a case which is throwing alarming signals to all of us. Now the next is case which is limited to testing the possibility of a book profit taxation. This was a case in which the company had under certain sales tax scheme, had obtained the benefit of deferring the payment of sales tax which it had collected. Under that scheme, later on, the modified scheme, the company was entitled to prepone the payment which had been deferred by the government, which had been deferred by the state government, and in preponing that payment, the company was given a hefty discount. Obviously, it was on account of the net present value of the amount which was otherwise payable on deferral. The difference between the net present value and the amount that was collected and debited to P&L account So in that difference, was it to be taxed as income? Was it to be taxed as an income? And in this case, the company had credited it to P&L account. In some cases, it might have been carried to the reserves also. The short issue therefore was that, whether was it taxable or not. And the company perhaps was emboldened by the fact that this special bench in Sulzer India's case had taken a stand in somewhat identical circumstances that it was not exposed to book profit. This case of special bench was impressed upon, was explained, was brought to the notice of the tribunal. This was a division bench, that was a special bench case. And the tribunal, for the reasons known to it, did not agree with Sulzer's case and stated that, when the company has chosen to credit it to the profit and loss account, who are we to grant an exemption in respect of this profit? So this is what, as we are seeing is that, these decisions is good to appreciate what are the ratios of these decisions, but none of them provide you with a finality. You will have to take your own calls based on your wisdom, based on your analysis, and finally come to. Because as we would see, even Supreme Court cases, are not being considered even by its own benches. Okay, so therefore, in such cases, one will have to be a bit circumspect, especially when it comes to the revenue laws. Now, before Sulzer India, there was another special bench decision in the context of rain commodities, which was a Hyderabad special bench, and there the issue was that whether the capital gains, which was otherwise exempt from taxation, should it be exposed to the book profit? And the rain commodities said that yes, it should be exposed to the book profit. Sulzer India later on, in the context of the peculiar facts of net present value discounting, stated that it will not be taxable, and I would concur with that decision in these facts of the cases that there was no income element into it. By preponing the payment, you don't make any income. What you were required to pay at a later point of time, you are paying it today. So there is no income element into it. Forget about the receipt element also. So therefore, in such circumstances, in Sulzer's case, perhaps the special bench was right in holding, and this bench, in my personal view, is incorrect in not following this special bench case.
When there is no specific 300, 150 JV company, could explain how it can be.
The short point, Ketan, is there the issue in computing book profit is never, that whether it is income or whether it is required to be included or not. The issue is to be tested on the touchstone of whether part 2 and part 3 of schedule 3 requires you to credit it to the profit and loss account or not. Once it is required to be credited, and if you are not so credited, AO is empowered to make adjustments. Apollo Tires makes it very clear. Okay, that is one thing. If you have not done it, AO will make an adjustment. If you have done it, can you exclude it? You can exclude it only if the explanation under any one of its long list of limbs, permits you to exclude it. And as I see, it does not permit. So therefore, that's why I say that that you have to take that decision with a pinch of salt. Other view is possible. Okay, right. Now the next again is a good decision which has come in from Karnataka Tribunal High Court. This is a case wherein when a loan is received by a partnership firm, from a limited company which has an accumulated profit, whether such loan is liable to be taxed as dividend income, deemed dividend, if yes, in whose hands? Now in the case when you comply with the provisions of 222E, there is not much of a dispute that it is a deemed dividend. You cannot argue that it is not a deemed dividend because accumulated profit is there. There is a company which is a closely held company, and there is a recipient who has received it as a loan or an advance, and there is an admission of the fact that it is not in the ordinary course of business. If these facts are overwhelming, then apparently the short issue which remains to be examined is in whose hands it is to be taxed. You have Universal Medicare, Bombay High Court, and you have Ankit and Hilltop, Delhi and Rajasthan High Court, which have taken a view that that it should be taxed in the hands of a person who is a registered shareholder. In the hands of the person who is a registered shareholder. Now admittedly a partnership firm would not ordinarily be permitted to hold shares in its name. Realizing this difficulty, the Delhi High Court a few years back in the case of National Travel had taken a stand that in a peculiar facts of the case, making a distinction because of the partnership investment, even where the shares were held in the names of the partners, it would be taxed in the hands of the partnership firm. This was a fantastic decision and a standalone decision. Okay, so it distinguished Bernick-Collar special bench by stating that Bernick-Collar is a good law. We have no dispute with that, but in the context where the shares are beneficially held by the partnership firm, we will tax it. Now this is a decision which, without referring to that, Karnataka High Court, without referring to that decision, because it perhaps was not brought to its notice, has taken a stand that no, it cannot be ever taxed in the hands of the partnership firm, because partnership firm may be a beneficial shareholder, but it is not a registered shareholder. So if at all if it is to be taxed, it should be taxed in the hands of the registered shareholder. Now whether that is possible or not, today we are not going to get into that debate. It may be that okay, even that cannot be taxed and this cannot be taxed, but this number is case the Karnataka High Court, following its earlier decision, has taken a stand without referring to or therefore dissenting with National Travel that this will not be taxed in the hands of the partnership firm. And I would believe it is the correct decision that partnership firm cannot be taxed unless partnership firm is actually holding the shares. If universal Medicare is the correct decision, which I believe it is, therefore in that way of the matter, this is a better decision to follow. National Travel is 347, page 305, and this 44 taxman 48 is earlier decision Sarva Equity Limited of the Karnataka High Court, which it had followed.
This Bhumik and all that, again it is approved as in fact
Very recently, yes, yeah, right, yeah. Okay. Then we come to a debate, which is perhaps, in my mind is a national debate. When two persons get together for the purpose of doing business, and if the relationship is governed by an agreement which is called a deed of partnership, and the idea is to share profits and each party is representing each other, then in that case it would be taxed as partnership. It will be taxed under as in the status of a firm. When two persons come together and they constitute a relationship which is not governed by a deed of partnership, it perhaps may lead to formation of an association of persons, and in some cases it could be body of individuals. In most of the cases, the present business style as far as the infrastructure development is concerned or the real estate development is concerned, you have something like which is known as a JV relationship. They are loosely called joint venture, they are loosely called some other terms, see right here. There is no special purpose vehicle which has been constituted for the purposes of this, and therefore in such cases the issue that often arises is that whether this is an association of persons, and therefore should it be taxed as an AOP or should it be taxed on standalone basis, each partner, each person, each JV partner would be taxed in its own rights, in its own hands. The issue assumes greater proportions when it comes to the participants, wherein one of the participants is a non-resident. If it is treated on a standalone basis, if the parties are treated to be independently, are to be taxed independently, then in such case, the non-resident party would be taxed in India only if it has a PIN and not otherwise. If the major transactions are concluded outside India, then the question of it being taxed even after the amendments of 2012 is highly susceptible. But if it is treated as an association of person, the entire income of the association is exposed to Indian taxation, and this is something which is not to the liking of the non-resident. Whether that is correct, whether it is moral or ethical, we are not getting into those issues, but the apparent thing is that this is not. So there has always been an endeavor by a JV non-resident partner to treat this on at arm's length distance, and therefore they should be taxed independently. Since last 6 years or so, there has been a debate before the authority of advance ruling. The first one started with Vanard's case, wherein the authority took a stand that AOP is not constituted. After some water had flown, in Geo Consultants case, they took a stand that they do constitute an AOP. These are the cases wherein the Indian company and the foreign company come together for the purposes of subscribing to the tenders, for the purposes of begging the orders. The parties works are listed, their finances are listed, their work profile is listed, and the cost also is independently incurred. So in all such backgrounds, Geo Consultant took a view that you have come together for the purposes of doing business and you constitute an AOP. Then after Hyosam's case, once again authority had a turnaround and stated that it does not constitute AOP. That case was followed in Mitsubishi's case. Again they said that it did not constitute an AOP. And in between Linde case, and in Linde's case the authority was very powerful in stating that that this is constituting an AOP. This was a joint venture between Samsung and Linde, and the issue was whether it constituted, and the authority said nothing doing, it is an association of person. As the parties were so advised, it approached the Delhi High Court. It approached the Delhi High Court in a writ jurisdiction and asked the High Court to review the entire decision. And the High Court on certain parameters which were explained to the High Court has taken a stand which perhaps would be the guiding factor for deciding the real estate JV AOPs also and the other AOPs also. What are the factors which with the High Court? Will take few minutes in order to appreciate. The revenues case was hanging on few important things. It said that the parties had admittedly come together under an agreement to do business. A. Secondly, it had jointly applied for a project which was awarded to this. The government of India had awarded the project to the joint entity and not individually. Fourth, that the objective of both the parties was to carry out the project work. And in that view of the matter, and the last thing was that the liabilities of the parties was joint and several. The liabilities of the parties was joint and several. The last thing which was pointed out by the revenue authorities was an explanation which was inserted in subsection 31 with effect from 1/4/2009, which provided that that whether you are constituted, you come together for the purposes of deriving profit or not is not a factor that would decide whether you are an association of person. Now this is an important explanation which most of us overlook. We read the historical definition and do not take into account the amendments which have been made in this. The court, after examining all these facts, bringing in the entire gamut of the case law, commencing from Indira Balkrishnan to this Yosam's case, pointed out certain significant factors. The court stated that they had come together for the limited purpose of obtaining the award of the project. The second point was the court said that both of them operated independently in their spheres in as much as one was technically competent to do an X work, the competence of the other partner never related to that. It was in respect of an altogether different field. The objectives and the tasks which each of them were required to be performing were very clearly listed, and not only listed but were also conveyed to the government of India that this task will be carried out by this and the other task was to be carried out by this. The task which was required to be carried out at arm's length by each of them was required to be funded out of their own respective funds. So there was no intermingling of funds, which was also something which was important for the court. The court also noted that at no point of time these parties were to receive a joint sale consideration. This also was very important. Had they received the consideration and thereafter split it in two parts, there could have been a trouble. As against that, in this case, the government itself had agreed to make the payments on their respective performance individually to each of them. And lastly, the court also noted that that in this case there was no sharing of profits or losses. Each of them were responsible for their respective share of profits or losses. So there was no commonality of the object, but for the object of procuring the tender, which was a common objective. In this background, the court stated that this did not constitute an association of person. I would believe that this is a well-considered decision, and in all such cases, if this care has been taken right from drafting of the document in para 1 to para 50, then perhaps you would be in a safer things, in safer waters. The next decision is just to impress upon all of us is that these 2012 amendments, which are known as Vodafone amendments, which have been carried out in most of the cases with effect from 1462 or 1976, whether they have actually, whether they have rewritten the law of international taxation or not is a short point which we have to examine is. In this case, the court comes to a conclusion that unless you amend the double tax avoidance agreement with the respective country, it will always override the provisions of Income Tax Act by virtue of Section 90 and 91. And as long as the DTAA is not amended, remains unamended, it would not be possible to give effect to the provisions of 916 explanation 3 explanation 4 as amended 915 and 917. This is the short point which we have to carry home is that so whenever there is an issue, instead of being flabbergasted by the amendments, one should carefully look into the provisions of DTAA, and if one's case is outside the ambit of 9.1, then in that case it would be governed by DTAA. The question of applying 9.1 does not arise at all. With that we come to the next case. I am not sure whether we have already discussed in this forum is Dawoodi Bohra Jamaat's case. It is section 11 to 13. It's a Supreme Court decision. Have we discussed it in the past? No. Okay. Now this is a case, it's a Supreme Court case, and therefore will have to be considered with full respect. This was a case wherein an application under 12A or 12AA was made by this Jamaat for the registration of the trust. The commissioner had rejected the application on the ground that this was a trust constituted for the welfare of a community. Constituted for the welfare of a community, and therefore in that view of the matter that registration was not to be granted. This denial of registration had to independently travel up to the Supreme Court, and the Supreme Court, after first being reluctant to look into the facts which are noted by the tribunal, examined the facts de novo and came to a conclusion that the fact that you are constituted to canvass the tenets of Quran and the religion of Islam by itself did not make it a trust which was constituted only for the welfare of a particular community. The tenets of Quran were wider enough and either to be treated as the charitable purpose, or in the alternative the trust could be treated as a religious trust. And the Supreme Court has given an affirmative finding that this was a trust which was charitable as also a religious trust. And in that view of the matter, it was entitled for the registration under 12AA. And thereafter, subject to, of course, compliance of other conditions, may be welcome to gain the benefit of Section 11. This is the nutshell of it. So therefore, if one sees the present trend in terms of labeling a trust to be either a community trust or a religious trust, presently it has been understood by the tribunal and by the courts is that a trust recommending the study or promoting the study of tenets of Vedas, or even for that matter, say tenets of Shiva or Parvati and such other things, or Gayatri Mantra, are not considered to be trusts which are devoted only for the welfare or the benefit of a community. They are considered to be either for charitable purpose, or they are otherwise considered to be for religious purpose. And therefore the registration may not be knocked down on that account. Howsoever, after the amendment of 2014, wherein now the Chief Commissioner or the Commissioner is empowered on account of 4 further grounds in which registration can be refused or not. Whether this case would fit into that or not, on a first flash I would believe that even those amended provisions will not entitle a Commissioner to refuse the registration in respect of such trust. The next again is just confirming an important proposition in the context of charitable trustees, that all of us are aware that yes, that the receipts of a trust or the income of a trust is to be applied for the charitable purpose, and in the year 1 it is to the extent of 85%. If you do not wish to do so, you need to accumulate it. The short question here which is arising for consideration is that in the year 1, if I have failed to apply the proceeds or receipts or donation or income, can I do so in the year 2? Can I do so in the year 2? If I read the law, I see that yes, that 15% of it could be applied in the next year, 85% has to be done within the year. Now this is a decision which has taken a stand in the peculiar facts of the cases, that it is possible for you to apply the income in the subsequent year, and that would be the sufficient compliance of section 11. This is what it is. Now here was a case in which, in order to meet the expenditure of the trust, it had taken certain loans. These very loans which were taken were repaid in the subsequent year, and the issue was that whether repayment of loan could be considered as an application of income or not, and the court was taken to the earlier decisions in the context of educational loans which were taken and such other things, and the court had concluded, after of course expanding the scope of that circular, which was in relation to certain loans which were taken and thereafter repaid for certain purposes. Now in such background, this view has been taken, and I would welcome this view because I would believe it is the correct way of interpreting. On such issues which we are discussing, independent of the time factor, if you have some view which is a serious view dissenting from what we are discussing, we are open. My job today is largely to put forward the views of the courts before you. In some cases, wherein I feel it is necessary, I am also putting my view for your consideration. But if there is another view, then please put it forward, so that there is a clarity. More so when the other view is supported by some other decision which is contrary to what has been provided, and it is all likely that I may not have noticed that decision. Possibly. Yeah. Now the next case is Bolgiri Industries case. It again is a case, say one always thought that at the time when I started practice, I thought it was a settled issue. I do not know at the time when I would retire whether this would ever be settled or not. This is a case wherein the company had received a loan. From a bank, and it had also agreed to pay interest on it. It was religiously paying interest, and thereafter it became sick. And for several years it could not pay the interest also. There came a time that at that point of a time it settled the amount in what is popularly known as a one-time settlement scheme, where under a part of the loan was compromised and a part of interest also was compromised. Okay, the part of the loan that was compromised was credited to the profit and loss account, and shortly the interest also that was remitted also was credited to this. Now in this case, in Bolgiri's case, the issue about interest taxation is not there. The short issue about is that whether this loan which was credited to the P&L account, should it be considered as an income within the four corners of 41(1). Before the court, reliance was placed on Mahindra & Mahindra Bombay High Court's jurisdictional High Court's decision, and it was explained that when a loan which was credited to P&L account, it will not be hit by 41(1) because the sine qua non of 41(1) was what? That it should have been in the past allowed as a deduction. If it has not been allowed as a deduction, the question of taxing it again does not arise at all. The court fortunately concurred with it. That yes, M&M applies, and in that view of the matter there should not be a difficulty. However, you are aware that there is a dissenting decision of the very same Bombay High Court which did not follow the M&M case in the case of solid containers, and that decision is 308 IPR 407. It's a Bombay High Court decision. Now we have a MP High Court decision, we have a Bombay High Court decision, and in which there is a dissenting decision, so you have to take your own call. Now, what was important in solid containers case, though it is not subject matter of today's discussion, but discussion would be incomplete otherwise. The Bombay High Court sought to distinguish the Mahindra's case on the ground that the loan which was taken by solid containers was taken for the purposes of funding the working capital. For making payment to the trade creditors. And in that view of the matter, it always had a business character, and therefore on cessation of a liability it will become taxable. Now, assuming that in some manner it would have been taxed as business income, one fails to appreciate how within the tenets of 41(1) it could have been taxed. Because what is fundamentally required for 41(1) is that I should have got a deduction. Before the deduction, the amount which was remaining to be paid has been remitted and some relief has been obtained. But these decisions keep on regularly hitting the tribunal and the high courts, and the assessing officers are very routinely taking a stand that even when a loan is written off, there is a problem, and when a loan that has been written off is on account of a working capital, you should think twice before covering it up in the profit and loss account. And this would be clear again when we refer to the next decision, and a few of the decisions which are surrounding that decision is. This is Gujarat High Court's decision, wherein in this case the assessee had admittedly not written it back. There was no remission of the liability. The creditor had not paid off this liability. Creditor continued to pester the assessee, but the assessee did not want to pay this money, but it religiously carried it on the liability side of its balance sheet. After some 7 years or so, the assessing officer added each, stating that you had enough of fun, okay, now let me tax this as a business income. The assessee stated that please look into 41(1), please also look into the explanation to 41(1). I have not done anything, okay, and therefore in that view of the matter it cannot be taxed. And in this case there were certain business creditors, there were certain loan creditors also. The AO had issued summons to some of the creditors. Some of the creditors were not available at the premises. Some of them refused, stating that I had never any business with these persons. Okay, so now in this case the assessing officer was therefore bolstered to tax this entirely as income. When the matter went to the Gujarat High Court said that two things. First, in respect of loans, where is the question of this? That this could not have been taxed as income under 41(1). Second is, even under 41(1), even in respect of trade creditors, it could not have applied because there is no right back of it. Thirdly, what is so important that has happened in this year, whereunder you want to tax him in this year? Is there any taxable event which has taken place in this year whereunder you would like to tax? If the collective answers are no, no and no, then in that case please do not tax this person. If this is the place where if the matter had ended, I would have been very happy. As far as this case is concerned, it had ended, but the matter is not nationally ended. And what is the law? Just write it down if you wish to. There is Delhi High Court's hotlines case. In Hotline Electric 205 Taxman 245, Delhi High Court has taken a similar view that you cannot tax anyone left, right and center. I don't need this. It's hot. Then there is yet another High Court decision, same from the same stable of Delhi High Court, Vardhan Overseas, 343 ITR 308. All of these have followed the earlier Bombay High Court decisions, very old decision, Jacques case, Bombay Dyeing case, and such other case, Kohinoor's case. But the latest decision of the Delhi High Court in Chiefs of Technologies case, 210 Taxmin 173, has brought this entire amount to taxation in the year in which the AO himself has taxed it. Without identifying a taxable event, the Delhi High Court stated, relying on sugar mills and other decisions, ignoring other important decisions, in this case relying on TVS Iyengar's decision, came to a conclusion that it is taxable. Okay, then the next one is a good decision. 14A I should take. No, let me finish this. One decision, that is serial number 13. Ramkishan Gupta, it's a Allahabad High Court decision. This is a case in which the assessing officer had applied section 43(5) to treat certain losses as losses pertaining to speculative transaction losses. These are admittedly transactions in respect of shares, admittedly deals in respect of which delivery was not taken, and therefore 43(5) was applied. Before the High Court, it was explained two things. One is that that these transactions were with my brokers, between the brokers, and therefore in that view of the matter, if at all, if anything is to be applied, net transactions only should be considered and not the loss part of it. The second important argument which was made out was that look here, I am a broker and I am a jobber also. I am a middleman and my case is covered by clause C of 43(5), proviso to clause C. I mean clause C to the proviso, and therefore in that view of the matter, as I am a jobber, I should be given the benefit. The court asked that how do you become a jobber? The person said that I am a member of the stock exchange, I am entitled to do the broking on the platform of the stock exchange, and therefore this transaction should be considered as jobbing transaction. And the court's attention was brought also to one of the earlier decision in the case of Sri Shravan Kumar Agarwal, that is 249 ITR 333. The court stated therefore that if a person is a jobber and if he is authorized to act as a jobber by SEBI, in this case it was not SEBI approved. This jobbing license was not granted by SEBI, but broking license was approved. In spite of that, the court said that in usual circumstances that it is important that the jobber is registered with SEBI, but even where it is not, if the transactions are of jobbing, in such case, the benefit of clause C should be available. That is the next one. Yeah, now if you wish, we can take.
Friends, now for 5 minutes, we will discuss this legal magazine by Priti Shukla. She is also a regular speaker in our particular for legal magazine. She is from LLM. She is presently working as an independent advocate, having 7 years of experience in litigation, in advisory work, on drafting work. And with this, I request Priti, before that I will request President Father Saula to offer a memento as part of love and humanity. I request Priti to discuss the legal action in the Parliament.
Yeah, please.
I am discussing 3 maxims today, and the first maxim will be quid facit per alium facit per se. It means the acts done by through agents or through any second person acting on behalf of the principal will be ratified as if the act has been done by the principal itself. This, the literal meaning of this maxim is that principal is personally liable for the negligence of its agent. In this video, I am going to discuss one case of H.E. Nasir Abdullah Hussain versus DIT. It is 84 ITD, page number 43, Mumbai Tribunal decision. In this case, the assessee was running a activity of breeding of race horses and also racing them in horse races. The assessee claimed carry forward of losses under section 74A. The assessing officer disallowed only on the ground that since the assessee himself has not done the work of maintaining the horse and it was done through some stud farm, so he has disallowed those expenditure. The Commissioner of Appeals confirmed those disallowances. On further appeal in tribunal, the tribunal relied on this maxim, that is quid facit olim facit per se. The tribunal has said that he who does a thing to another does it himself. The purport of section 74A, that is was the assessee must be the owner of the horses and he must also maintain those horses. Since the assessee has done those work through the stud farm, that doesn't mean that he has not carried on this activity. That stud farm activities, they have done that work on the behalf of the principal, that is the assessee. So on that basis, a tribunal has said that horses could be maintained through others also. The assessee appointed a stud farm for the maintenance of horses. Due amount was paid for the maintenance by the assessee. The consideration for such payment was services offered by the stud farm. Therefore, assessee was entitled for deduction under section 74A(3) of the Act. Second one, I am taking that is ultra vires. Ultra vires, that means that is anything beyond the powers of the legislature. Means anything which it will not be illegal, but anything which it is not in the control of any legislature or any court, it will not be recognized in the court of law. This maxim was discussed in the case of CIT versus Shah Electrical Corporation at 207 ITR 350 Gujarat High Court decision. In this case, the ITO, that is the assessing officer, imposed the penalty on the assessee under section 140A(3) for non-payment of self-assessment tax. The assessing officer disallowed the penalty. The CIT has reduced the penalty, and in further appeal in tribunal, the tribunal cancelled the penalty, saying held that the penalty was not sustainable under section 40A, as there was some Madras High Court decision wherein this section 140A(3) was declared as ultra vires. So on that basis, tribunal deleted the penalty. On a reference in the High Court, the High Court reversed the decision of the tribunals relying on this particular maxim ultra vires, saying that the legal position that while deciding a reference, the High Court has to consider the legal position obtaining on the date on which it is deciding the reference and not the legal position which existed when the tribunal decided the appeal. Therefore, on that basis, the High Court reversed the decision of the Honorable Tribunal. The third one which I am taking it is ex viceribus actus. This maxim literally means that anything which should be done within the four corners of the Act, anything decision should be taken within the four corners of the Act. In this case, what has happened, I am referring one case of DCIT versus Vickers System International Limited. In this case, the assessee has paid company, he had paid some ex gratia amount to bonus to in excess of the amount which the assessing officer disallowed, as there has been excess. On further appeal in CIT appeals allowed the expenditure. On further appeal in tribunal, relying on this particular maxim, that is ex viceribus actus, the tribunal has given a very good ratio, saying that in the light of the that's when the section what has happened in this case, but basically the assessing has claimed that first of all my expenditure need to be allowed under section 36(1)(3) and if not under section 37(1). But what tribunal said that no, so relying on this particular maxim, there is a section 36(1) is a specific provision, whereas 37(1) is the residuary provision. Anything which falls within the four corners of section 36(1) will not fall under section 37(1). So accordingly, it was allowed by the tribunals, saying that it was established with reference to the record that there was a general practice of making such ex gratia bonus to the employees. As such, the SEC complied with the conditions contained in section 36(1), and for that purpose, it was allowed by this tribunal. This is what I can conclude.
Yeah, thank you, Priti, particularly covering the three magazines in just 5 minutes. It was really commendable. With this, I request Prati to continue.
My personal thanks, Priti. It was wonderful, see, to cover all three important magazines in just a short time, and that to explain them with the case laws was a very, very nice thing. And this understanding this legal magazine is unique to this study group. And I always look forward to this is kind of an incentive to be a part of this group for the reason that this entire law which we are studying, whether this law or the other law, is based on jurisprudence, and our jurisprudence as we understand is based on the Latin maxims. So therefore understanding these maxims is very important, and then they take us to the लेके जाओ black tea and hot water or otherwise black tea, either this is okay. Coming back is the next one is the Sahara's case on 14A. Now 14A, as we have seen, is that there is a flip-flop. There is an eternal debate on 14A, and it seems that it will not die ever. Okay, so therefore we had understood in the context of 14A. Now what we are discussing is the one wherein Rule 8D also is applicable. So therefore now we are not in those days wherein Godrej and boys used to say that 8D is not applicable because it is assessment up to 7-8. Now these are the cases which we are discussing are post 7-8 cases, and therefore 8D otherwise is applicable. One of the facets, there are several facets of it, and we are touching upon just one of it. And one of it was that there was a debate that if the person in a relevant year did not have any exempt income in that year, then in that case would 14A ever be applicable for the purposes of disallowance. And then we had again series of decisions, some of them saying that yes, when there is no income, there is the question of applying it. And all this controversy was believed to have been sealed by the special bench decision of the Delhi tribunal in Cam Impas's case. When the tribunal said that reading 14A in its manner in which it is drafted, read with Rule 8D, we do not, thank you so much, we do not gather anything which requires that, for an assessing officer to first establish that there was an income in respect of which exemption was claimed. Perhaps it went into say in so many words that even when there was a propensity or a potential income which could have been exempted, potential of earning an income which could have been exempted, the fact that you have incurred expenditure was sufficient, and therefore it was subjected to disallowance. It is this very issue which came up in Sahara's case in slightly different kinds of faxes. This was a case wherein the Sahara company had some income. It was not a case wherein there was no income from dividend at all. It had income to the tune of about 60 lakhs of rupees or so whatsoever. Facts could be little different. Okay. And the assessing officer had dutifully calculated the disallowance by applying Rule 8D, and according to the calculation it came to 2.60 crores. So the disallowance far exceeded the amount of exempt income. The CIT appeal confirmed the action of the assessing officer in as much as the assessing officer had disallowed about 60,000 or such amount, while the CIT appeal recomputed it and disallowed 2.60 crores. So this was a case of an enhancement of this thing. Before the tribunal, all these aspects were placed. The decision of the Delhi tribunal also was explained to the tribunal. It was a special bench decision of its own tribe, and therefore it was perhaps required to follow that decision. But what impressed the tribunal was that that tribunal stated that we have noticed that that there are thousands of decisions on this aspect. Some have taken one view, some have taken another view. Even to apply those decisions is humanly impossible for the tribunal, and therefore in that view of the matter what is required to be done is that a humanitarian and a judicial view, a rational or a logical view was required to be taken in the context of the disallowance. And the rationality therefore which was provided by the tribunal in this case was that 50% of the income was sought to be disallowed. 50% of the income was sought to be disallowed instead of 8D. So a goodbye was given to 8D. 14A was sought to be applied in a very different manner. The computation mechanism was not relevant. The decision of its own special bench was not relevant, and what impressed the tribunal was there was a decision of a Chandigarh tribunal which was delivered before the special bench decision, which perhaps is not a reported decision but which was cited before the tribunal, wherein it was a view was taken that yes, that if there was no income, the question of applying the rule 8D does not arise at all. And that decision was this Cami Invest is 124 TTJ 577, which is against the assessee. And the other decision which favored the assessee is Punjab State Cooperative and Marketing Federation. It's carrying ITA number 548 / Chandigarh / 2011. So therefore presently you have some tool which can be operated upon in order to claim that please disallow something which is rational. Don't just mechanically apply rule 8D for the purposes of computation. Now I ask myself that if special bench is correct in its logic, special bench has stated that even when there is no income, rule 8D will be applied in its full force. Because there is no income, so there is no yardstick of 50% that also could be disallowed. So therefore either there would be a total disallowance or there would be no disallowance. So you'll have to take your own call before you do so. So next is a decision, LML's case. A short point which is sought to be made out here is that there was a contribution which was made by the company to the Officers Club and the Workers Benevolent Fund. And this contribution was disallowed by the assessing officer on the ground that 40A9 applied to such contributions, and failure to comply with the provisions of 40A9 would not entitle the assessee to this. I just would like to place before you few cases which have taken a contrary view, and therefore this will be of benefit to us. 78 ITD 175 Mumbai, 26 ITD 413 Mumbai, and there is a Bombay High Court decision 264 ITR 83. All of them have taken a view that in such cases the fact that the money had been spent is important, and therefore in such cases once there was an outgoing, once there was an outgoing to an independent fund, the question that that fund should have been registered, it would have been applied, commissioner should have approved such things, all those things pale into insignificance. The other case, once again LML's case only, this was a case in which that LML had entered into a JV. LML had entered into a JV for the purposes of manufacturing Vespa scooters with an Italian company, and that was a special purpose vehicle. For the purposes of raising the loan, bank loans and other credits by that JV company, SPV, LML had granted guarantees, had guaranteed the performance of this JV. After some time, this company, which was a JV company, could not repay the loan. The bank and the other NBFCs exercised their credits, exercised the guarantees, and made LML pay this amount, which was paid in a one-time settlement at a reduced amount. This amount was thought to be claimed as a business expenditure in the hands of LML. This amount was thought to be claimed as a business expenditure, and the old law was sought to be explained. Even 288 ITR page 1 essay builders case was sought to be explained. was placed in service, but all of this did not impress the court, and the court came to a conclusion, the tribunal in this case, came to a conclusion that this amount was not allowable as a deduction, for the reason that even where the JV itself wanted to have claimed this deduction as a loss, it would not have been allowed. Then there is the question of LML, who was otherwise not in the business of guaranteeing the performance of the liabilities by the other companies. It was not receiving any credit commission. It was not in the business of this providing guarantees, and therefore was not allowable as a deduction. Maybe yes, on the facts you might agree to this decision, but if I follow the Supreme Court decision, 77 ITR page 751 was the decision which was followed, and 288 page 1 was distinguished. I believe that there still would be some hope in continuing these cases, because here is a case for the purposes of the survival of a JV. You have paid some money and it was your business to be a part of the JV, so therefore there was surely a business nexus. Only whether it was in a capital field or a revenue field, this perhaps is a clincher which will decide.
Business loss 36 ITR.
Yes, yeah. So should it be claimed as a business loss or should it be otherwise? Yes, yeah. Possibly, yes, yeah. That's why I said
I think it is possible.
not Badridas Daga, but I believe that there is a possibility on account of a business nexus that I had an interest, in the company from which I was likely to earn income. Okay, that income could have been taxed. I'm not saying that it would not have been taxed or taxed. If that income could have been taxed, and that for performance of that, for earning that income, whatever I am doing, I am required to do it. Perhaps, see, under the agreement I would have agreed, taken it up as my obligation to provide the bank guarantees. Yeah, I would be. In this case, unfortunately, there was no guarantee commission moving from the SPV to this. Had that been moving, there would have been a better case. There would have been. Sorry. That's why they said it is a capital expenditure. That's why they said it's a capital expenditure. Yes. Sorry. Yes. Yeah. There is a good case. Yeah. Right. Yeah. Sometimes what happens is your bad facts or otherwise the quantum is so huge, that it's difficult, to straight away allow it. Yeah, that's all. Yes.
There was never a case of earning of income.
No, but there was a remote possibility of earning an income. See, what was it? It was SA Builders case. It was a case of a subsidiary. Okay, so income, which would have otherwise come, not in the form of interest. That's why I'm saying that. Had that been an interest, there was never a debate. It would have been allowed as a deduction. But yes, yeah. Then the next is the case of Rajmoti Industries. It's a Gujarat High Court decision. This is just amplifying an important thing which many a times most of us overlook, is that what 40A3 perhaps provides is a case of an account pay check payment and not a crossed account check payment. So it is accepting the decision in favor of the position in favor of the revenue, stating that when a payment is made by a cross check, it is not necessarily strictly in compliance of 40A3. It has to be by an account pay check. This is the distinction which it is making, and importantly it's a High Court decision, so therefore you need to respect that decision. The next one is again a Gujarat High Court decision, back to back. It is stating this is a case in which the company was in the business of distributing SIM cards. The SIM cards which were being distributed, which I understand is Docomo SIM cards. So Tata Tele Service Company had appointed this company as the agents of that. Under the instructions of Tata Service, the company was required to ensure that the payments were made in cash and cash. Okay, the payments were made in cash, and therefore, wherever the payments were made, they were made in cash, because the company was not in a position to, was not willing to accept other things, other payments. So the issue therefore arose is whether such payments could be allowed as a deduction. Obviously, Rule 6DD would be pressed, obviously Sub-Rule J would be pressed, and the court agreed that yes, all this is not coming to your rescue. All this is not coming to your rescue because you do not fall under any of the exception of 6DD. But court thereafter invented a new thing and stated that Rule 6DD is not the last word on 40A3. That there could be exceptions. There could be exceptions which are beyond 6DD, and what is the twin condition which is important for any allowance under for avoiding the disallowance of 40A3 was that the payment must be genuine. If you are in a position to establish that the payment was genuine, and secondly, there was a circumstantial need to have made the payment in a mode other than account pay check. If you establish these two things outside Rule 6DD also, you will have a case. And the court itself relied on a few decisions. One was 290 ITR 702 Gujarat, 290 ITR 349 Rajasthan, and 206 Taxman 45 Delhi. This, to my mind, settles a heavy burden, for the reason that you are always under a consideration that when cash payment is made and your case is not covered by 6DD, if not for anything else, at least to save your skin as an auditor also, you have a concern that whether these payments are hit by 6DD, hit by 40A3 or not. So this is. We have two new cases which have been added, which I had failed to add in this. Those are on expenditure, and that's why I'm taking it here. The one is that all of you are aware of the Allahabad High Court decision in the case of Vector Shipping. Vector Shipping is a case which had taken a cue from Merlin Shipping, that special bench decision of the Vizag Tribunal, delivered in the context of 40 small a, small 1a. That when you do not deduct the tax whether you are hit by 40A1A or not. And the special bench had taken a fabulous view that if no money was outstanding at the year end, the question of applying 40A1A did not arise, because it was not an amount which was payable in respect of an expenditure. The view of the special bench was stayed by the Andhra Pradesh High Court, and thereafter you had Gujarat High Court in two cases and Calcutta High Court in one case. All of them had taken a view that special bench decision was laying down an incorrect law. Howsoever, you had an Allahabad High Court decision which had taken a view that special bench decision was a tenable decision, and therefore it should be applied. In between, the board had also issued circular saying that don't follow special bench, it is rubbish. Okay. Thereafter, then the issue came before the tribunals, and for once tribunals were in a serious fix. They were unable to decide which way to go, to follow all those three decisions or to follow Allahabad High Court decision. So then there were a series of decisions from the Mumbai tribunal stating that we will not follow the Allahabad High Court, and for that a circuitous way out was taken, which we will not discuss. But then there was a Chennai tribunal decision. Vice President Roke Narayan took a stand that when I have two decisions, then obviously a view which is beneficial to the assessee should be taken, and therefore he took a view that it should be allowed as a deduction. Now it is this case, which had presently come, which we are trying to do, is this Vector Shipping's case, this Allahabad High Court's case, and the department had sought a leave to file an SLP in the Supreme Court. Before the Supreme Court rejected the SLP. Now the outcome of such rejection would be that in such case the Vector Shipping's decision, unless it is reversed, would have become final. This is the one way of looking at it. Of course, today it is fashionable for all of us to say that, rejection of LLP means something else and it should not be considered as the final law of the land and all such other things. But presently now an SLP has been rejected. So whether all those tribunals which have taken a contrary view, whether they would now be forced to take a view, because Supreme Court, while rejecting as in principle has approved the ratio of marine stripping. That's what is more important. It was believed that vector stripping, Allahabad High Court, by deciding the issue, decided it in favor of the SSE on a different ground and just referred to marine stripping and therefore should not be considered as a decision which was the special bench decision. But now this ratio would be different because Supreme Court has taken a note of the special bench decision, and now will it be any more possible for the tribunals to follow the other High Court decisions which are very, very well-reasoned decisions? Howsoever, this is the present position and I therefore thought that we might take a note of it. The vector stripping's decision, that is Allahabad High Court, is 357 ITR 642.
Interestingly, what has happened,
Yes.
both of them are in some different context, you see.
Yes.
Has said that the vector shipping has not finally fully approved the decision of marriage.
Exactly. Yes.
And therefore, and it is wrong to accept that marriage shipping has been approved by
Yes. Yes.
some different contextual decision.
Very, very truly, yes. And Ajay bhai, that is what is the unanimity amongst the Mumbai tribunal. But for Vice President's decision, Manmohan had taken a different view. But he himself presently refused to follow his own decision. So therefore, Mumbai tribunal was consistent in not applying vector shipping on the ground that vector shipping never conclusively approved this marine shipping. But now the story is different, see, right? So that one has to see whether that would be so or not.
Can we have a side of Chennai which just followed up
I'm sorry, see, I am getting lazy, so therefore, I have not put it here. But only that in a few months back, this has been covered in BCAJ in controversy column feature. Please look into that, yes. That Bombay Tribunal, which has taken a different view, is risky stockbroking. Is risky stockbroking. What is that message? Good. Yeah. You are aware? Chennai Tribunal. Yeah. Applied. You're right, yeah. They had applied. President also confirms that applying vegetable products, Supreme Court, Chennai Tribunal had taken a view which was beneficial to the SSE. That's what it is. Tikatir, yes, yeah, right. That is the decision. Very well. So quick. You got it on Google or what? Or you have kept it in your notes? Okay, very well, yes, yeah. Right, Tikatir is the case, yes, yeah. Yeah, the other one which routinely comes before us and for which all of us have a solution, and the conclusion that yes, that whenever there is a collection of the employee's contribution which is governed by 224 and 3615, if that has not been paid but has been paid within the due date of filing return of income, but it is paid outside the grace period under the respective legislations, will it be governed by the proviso 243B relaxing it, and therefore you will claim deduction in the year of incurring expenditure? And then we had decisions, we had presently some months back Bombay Tribunal taking a view that no, we will not even follow Delhi High Court decision, and therefore it had distinguished that decision, which was a very, very disturbing position. Now, see, we have Bombay High Court decision in the Hindustan Organic Chemicals Limited, and therefore I thought of bringing it to your attention. And that Bombay High Court decision is HOCL's case. It is once again on IT80 online, sir, this thing. Please look into that. I don't have the IT8 number. Okay, we'll now move little faster.
Against the assessor. The High Court has taken three of them.
Okay, which one? No, this is in favor of the assessee. That's why I brought it in your.
They follow other exclusion.
Yeah, exactly. It is in favor of the assessee. That's why, yeah. Right. In fact, to my mind, there is not a single High Court decision against the assessee on this ground. Okay, tribunal decision is there, but High Court is uniform on this. Yes. Okay. Now the next is a Supreme Court decision which we are trying to cover. In this case, the facts were like this: the person had agreed to transfer the residential premises. Agreed to transfer residential premises in year 1. For some reason, the agreement could not be acted upon, matlab the operation of that agreement was stayed because of certain proceedings, including certain legal proceedings. But the assessee had received consideration either in part or in full. It is this consideration which was back to back employed in acquiring the residential premises, and therefore the benefit of section 54 was claimed. Benefit of section 54 was claimed. It so happened that all these legal proceedings and stay and all this were vacated in the year 4. And at that point of a time, a transfer as is understood under 2 subsection 47 by handing over the possession and sealing the completion took place. So it is in these facts of the case, the matter went to the Supreme Court, and before the Supreme Court it was argued by the revenue that look here, this guy has purchased some premises, much before the transfer, and therefore it should not be given the benefit of it. Okay. Right. And the High Court also had said that sorry, we will not be of any help to you. And the matter had gone to Supreme Court. Okay. Matter had gone to Supreme Court in an SLP jurisdiction. And the court stated that there is also a different way of looking at it. Is that that the court's reading is that, mind you, that one is not very pleased or enamored by this view is because it all such decisions have the capacity to cut either ways. It can cut both the ways. Yes. And therefore what has happened is the court said that why do you say that transfer has not taken place in year 1? Court said that that on execution of an agreement some right has been transferred to the purchaser. Some right has been transferred to the purchaser, and right in rem to a limited extent has been converted into right in personam. And therefore, in that view of the matter, the assessee has transferred something in year 1, and within the period of 1 year or 2 years or 3 years have complied with the provisions of 54, and therefore the benefit of 54 should be granted. This is the way it has gone it. I ask myself that assuming that this was not a 54 issue, if this was not a 54 issue, and if it was the department which had taken a stand that I will text you in the year of agreement, there could have been horrifying situation. But the court has also, to be fair to the court, is also has invoked something which is called as purposive interpretation. So now this purposive interpretation, had it been used in the context of 54, it would have been wonderful. I believe so that it was so issued. If it was issued or utilized in the context of 2 subsection 47, there is a difficulty. So this is a decision you will have to take it with a little discretion.
If the department tries to fix it in the first year, can we not rely on the 53-year transfer property act and say that there is no effective possession given?
So that's what department is saying. That's what department was saying.
When it comes to taxing it in the year 1, will it not be?
So it would, but now with this ratio.
Decision having the coming context of.
So we have to appreciate this decision in a very limited context. Yes, because it operates within an absolutely narrow field. That's the way it is. This cannot be the law of this country. That's what I'm trying to say. Okay. Now what we do is that we will please mark case number 20, 22, 24, 27. So these are the 4 decisions, I believe, right? Yeah, 20, 22, 24 and 27. All of these relate to the year of taxation in cases where a landowner has executed a development agreement. A landowner has executed a development agreement. And how the courts or the tribunals, judiciaries blowing hot and blowing cold, is something which we need to appreciate in all these cases. The sum and substance of it is, in this case, is that in one of the cases it has been stated that the liability to pay tax arises in the year in which the consideration in the form of the constructed or the developed area is received by the landlord. Okay, if this is the law, it is wonderful law because it suits everybody, but the landlord would like to defer the taxation to the year of receipt of the consideration. So therefore, this is the Hyderabad Tribunal in the Bindu Sarias case. A view has been taken that that what is important is the receipt of consideration, and even though construction has been carried out, it should have been considered as a purposive possession. It should have been considered as a purposive possession, that is a possession given to carry out a purpose, but not a constructive or a legal possession. So therefore, in that view of the matter, it is not a possession within the four corners of possession as is understood by the general law or the Income Tax Act. This is one proposition which has been made. In Sadia Sheikh's case, that is a Bombay High Court decision delivered by the Panaji branch of the Bombay High Court, wherein the court refused to get into the area of possession. It stated that there is a finding of fact by the tribunal that yes, that the possession has not been given. If possession has not been given, then we will not follow our own High Court decision in the context of Chhatrabhuj Dwarkadas, is in the case of Chhatrabhuj Dwarkadas. The court was told that look, here is a case wherein the developer has entered the premises, it has constructed premises, it has agreed to sell the premises which are in the process of construction. If this is not possession, what is the possession? But it is a very short decision wherein the court refused to get into the finding of fact. Because rightly so, unless they were to be perverse findings by the tribunal, and perhaps that case was not proved. So this is yet another decision in favor of the assessee. These are 2 out of the 4 cases. The third decision is the decision of the Mumbai Tribunal. In a short decision, the tribunal takes a stand that what remains to be possessed where a construction has happened, where the developer is entitled to agree to sell the premises which are being developed by him, what is the possession? Whether, is possession a matter of an agreement or a document, or is possession a matter of reality? Without saying it in so many words, because some of the words I am supplying in order to impress upon you the seriousness of the aspects here is that this need not necessarily matter when said by the tribunal is. Then the last decision is a Allahabad High Court decision. Here is a case that there are 2 gentlemen who were co-owners of the land, had got into a development agreement, whereunder the developer was entitled to construct premises and agreed to sell the premises also. To my mind, in all 4 cases, there was a permission to enter the premises. Now that permission, you could consider it as a license to enter, or you consider it as parting with the possession. I leave it to you. Okay, so that in such circumstances, the Allahabad High Court has taken a view that if this is not a transfer, what is a transfer? Okay, my job was to, religiously place before you the facts and explain to you that what is the prevailing confusion which is happening is. Before I close, I consider it to be my duty to just bring it to your attention few aspects of it is that, there is a Bombay High Court decision in the name of Chhatrabhuj Dwarkadas, which has almost 6 to 8 years back has taken a clear stand by explaining various facets of a development agreement to come to a conclusion that it is in the year of execution of development agreement that you would be liable to pay tax. The liability to pay capital gains tax arises independent of receipt of consideration. It arises independent of approval of plans, it arises independent of settlement of claims. It arises independent of grant of a general power of attorney, irrevocable power of attorney. And surely it is independent of receipt of the full consideration. Possession has not been considered to be very material lot. The very fact that there was an agreement to part with possession perhaps was enough for Bombay High Court to come to a conclusion that it is in the year of execution of the development agreement. Two important facts which perhaps impressed the Bombay High Court in coming to this conclusion. Thereafter there are decisions of certain tribunals, of certain high courts also. There are 1 or 2 AR's decisions also. Some of them have favored, some of them have sought to dilute Chandragupta Dwarkadas for their own reasons. Some are unfathomable, some are ununderstandable also. What impressed the court were 2 factors. One is that why was 2 subsection 47 amended to introduce clause 5 and clause 6? It was in order to ensure that the government gets money in respect of transactions which had been deferred on account of the ground that the conveyance of an immovable property had not taken place. So anything which facilitated the enjoyment of an immovable property should be otherwise considered to be hit by this. So it read the memorandum explaining the provisions of amendment of section 247(1). And Bombay High Court innovated a very different theory, altogether different theory, which is not there in the 4 corners of Income Tax Act. It said that any agreement which facilitated the control or the management of a property, that was sufficient to attract 247. This is important, which most of the courts are not getting into it. And therefore, applying this theory, some of the courts stated that when a power of attorney is given, if this is not control and management, what else it is? Possession is not relevant, a power of attorney is relevant. Permitting a person to demolish the existing structure on the property was considered to be possession. So in all such cases, if one has to take a holistic view, one would believe that that do not get too enamored with these decisions, wherein see in certain corners a view favorable to assessee is taken. If you need to apply the law as is available, I am not saying Bombay High Court is the right decision, because I am not competent to challenge that decision. But what I understand to subsection 47 clause 5 is that you have to apply section 53A of the Transfer of Property Act. And if you comply with those provisions, there are few conditions. To my mind, 6 conditions is that there must be an immovable property. There must be an agreement. That agreement must be in writing. That agreement must be for the transfer of a property. It should be for a lawful consideration. In pursuance of that, some act should have been done. And lastly and importantly, the buyer should be willing to perform the terms and conditions of the agreement. If largely so, then in that case, if possession is parted with, then in that case there is surely a transfer. Now the $1 million issue is, when could you say a possession is parted with? Okay, some of the courts are saying that physical possession is important. Some of the courts are saying that even permitting a person to enter the premises is good enough. It need not necessarily be a legal possession. Some of the courts are saying giving a power of attorney is also a parting with possession, and therefore you should be. Some of the courts are saying that if a developer is entitled to sell the product, what else is required? It is the last nail in the coffin, and therefore you better pay tax on it. So this is, I have just placed before you the confusion which is presently prevailing. It's very, very difficult to get out of the rigors of the Bombay High Court decision. So one will have to, whenever one advises, one will have to read it again and again before you take a call, being enamored by the decisions which are favorable to the assessee. Yes. Yeah, right. But selling, right to sell, yes, yeah. And if I am advising the developer, which developer worth his salt will agree, to get a license without a right to sell? If I am putting in crores of rupees, I better have secure rights for my clients to sell the premises. Otherwise, how would it be so? So yes, there are cases, yes, wherein you can clinically get out of Bombay High Court is by simply getting into an agreement for sale. A simple agreement for sale clearly providing that pending the compliance of this, you will not be able to place anything. For the approval of the authorities, you will not be able to enter the premises. Unless this 50% payment is made, I will not part with possession. And you will not be entitled to sell the premises also. And a limited power is given whereunder the person can just prepare plans and put it up in my name as a landlord. To that extent, it should be, to my view, this would be a possible correction whereunder you should not be hit by the permission of this. Because even if you apply clause 6, which is a wider clause, it still does not enable the person to enjoy the property in any manner. As long as that is done, there should not be a difficulty. This power thing also.
What is your view on this legal possession?
I have no view. Whatever is the court's view is my. I'm just.
Legal possession versus physical possession.
I think after Bombay High Court, there is a great difficulty. There is one way of reading it is that even in an agreement, development agreement, that the fact that you provide that I will part with possession even after 12 months is providing for possession. So do not give too much of importance, to the fact of possession is. You might be covered somewhere. If the idea is to, because what Bombay High Court has done is that it has roped in the mischief rule. The Haddon's law has been put into action, and if mischief rule is to be applied independent of provisions of 2 subsection 47, it will be applied nonetheless. Yeah, right. Okay. So this is what it is. I believe that I am exceeding time. We will complete our discussion on capital gains, and by that also we would have covered about 30 cases, which I believe should be fair for all of us. The other case which we will be taking up is again a good case, is 149 ITD 117 Bangalore Tribunal Vikram Vishwanath. Is a 4714 case wherein a sole proprietary concern has been sought to be converted into a company, and the capital gain, which in this case was in the range of 339 crores, was sought to be claimed as exempt from purposes of capital gains. And the department brought out a very interesting and innovative argument in this. It stated that where is the business which could be succeeded. In this case, the person was an investor in the shares of one single company, whose value was 330 crores. His investment was just about 9 crores of rupees. For a period of almost a decade, he has been nourishing this investment. The original investment was just 4 lakhs of rupees. He had increased it to 9 crores of rupees, 4 crores of rupees, and thereafter he transferred it to a company in which he was the main sole shareholder, and there was one more shareholder for the purposes of compliance. The issue was that where was the business that could have been succeeded, because 4714 requires that there must have been a business which has been succeeded, and in the course of succession capital assets are transferred, and the gains should be in relation to this transfer of capital gains. The tribunal in a very roundabout manner has come to a conclusion that there was a business, and therefore it could have been succeeded. So what I am pointing out is that please take care that 47, 13 or 14 or even 13B are not licenses. wherein that anything and everything will get through. So you need to apply your mind. The second interesting argument which was canvassed was that, all right, assuming that there was a business, these shares were not a business asset. These shares were not a business asset, and the capital gains arising on transfer of these shares cannot be excluded under 4714. And this is where the tribunal came out rightly to my mind is that yes, it is true that that in the course of transfer a business must be succeeded to, and capital gain should arise in respect of assets which are part of business. But there could be assets other than assets which are non-business assets, and in respect of which capital gains can arise, and those capital gains also should not be taxed, which is a correct view. This is second argument which the tribunal gave in favor of the assessee. Third is a beautiful one which had not been canvassed by the assessee, but the tribunal coined it out, and that was, but look here, what are we talking about? That as far as the proprietor is concerned, what is the economic gain for him? He was the sole proprietor of these shares, and he is the sole shareholder but for the one who is holding a share just as a nominee. So in that case, see, there is no economic benefit as far as the shareholder is concerned, and when there is no economic benefit, where is the question of taxation? After having observed so, it finally held that 4714 applied to that case. But there is a handle available to you that in cases wherein your facts are similar to this case, maybe when you don't succeed on 4714 or 13, there could still be a handle to rotate wherein you can say that there is the economic benefit. Jai Kumar Chawla is empowered to issue commission under 131 for the purposes of 55A. There was a debate which seems to be correctly decided in favor of the revenue. This Zahir Mauritius is a good decision wherein the JV partner, that is non-resident JV partner, had transferred FCCD, which had been a common thing for a while in certain communes. These FCCDs were transferred, and the issue was that the gains which were made, was it interest? If it was interest, it was taxable. Was it capital gain? And the department's stress was that, look here, the income, these FCCDs were nothing but debt instruments, and therefore anything which is earned in relation to debt instrument should have the character of an interest, and 2 subsection 28 capital A was brought in service. The court said that, look here, this is not the right way of determining the thing is. The right thing is whether it was equity or debt which was not material, whether there was a capital asset, and even if it was a debt instrument, FCD was a debt instrument, it was nonetheless a capital asset, and when a capital asset is transferred, it gives rise to capital gains. That perhaps was a very beautiful way of concluding the debate which would have otherwise continued for a long period. So this is, and the other one is Compton Graves case. The short point is, I believe, though it is a jurisdictional high court decision, the case could have been decided otherwise. This was a case in, certain loans were given to subsidiaries which were later on converted into shares, and it is these shares which were transferred in respect of which huge losses were incurred. The court stated that these are losses under the head capital, but not the losses under the head capital gains, and therefore were not allowed to be adjusted or carried forward. Before we close, let's take a note of 2 decisions, 29 and 30. This is an interesting case wherein the tribunal was asked to decide that whether the interest which was paid on a loan which was taken from a bank against the security of an FD, whether it could be adjusted against the interest that was received on the FD itself. Whether it could have been, because the loan which was taken was employed for a different purpose of gifting it to a son or loaning it to a son, and it did not have any revenue source. There was no stream of revenue. A very innovative argument was placed before the tribunal is that, look here, that I did take this loan, instead of redeeming this, FD on a premature basis. Had I done it, then in that case I would have lost money, because at the time when I took loan, I was entitled to claim loan at the rate of 9%, while this FD was giving me an interest of 11%. Two things would have happened. One is I would have lost this money on a premature redemption, and secondly, that this very income which is my source of survival would have ended. Instead, what I did was that I took a beneficial route out, and therefore took a loan on which I took interest. So allow me to set off the interest which I have paid. And the tribunal examined the provisions of 57. This is Pramod Kumar's decision. Okay, and he has wonderfully applied the law of 57 is that what is an expenditure that has been allowed as a deduction? An expenditure that is allowed as a deduction is the one which has been incurred for the purposes of earning an income. If I had not incurred this expenditure, I would not have been earning that 11%. That's the one way of looking at it. There could surely be other way of looking at it. But somebody is willing to apply a fresh thought, and that is what is making one glad. That is, this is one case that it was allowed as a deduction. The other one is a 69C case. 69C is a provision which is not usually discussed by the tribunals, and therefore I thought that it is better to understand certain principles in law clearly. Now, this was a case wherein the person had made certain payments to a legal consultant, substantial payments, and this was debited to work in progress account. There was no dispute on that. He had not claimed this as a deduction. And this money was otherwise debited to the work in progress account. The assessing officer in his wisdom had treated this as an unexplained expenditure and invoked the provisions of 69 capital C. Rightly so, the tribunal disapproved of this entire action, and few emerging things, whether emerging out of the decision or otherwise, let's gather them. What is the law of 69C? Please apply this. Though it is titled to be an unexplained expenditure, basically it is talking about an explained expenditure. It should have been unaccounted expenditure and not unexplained expenditure. An expenditure for which an explanation is available can only be hit by 69C. But an expenditure for which an explanation is available which is not accounted for, that is the one which can be added. Principle 1. The second principle about 69C is 69C is not a disallowing provision. It is a provision for making an addition to the income of a person. It is in the genre of 68 to 69D. So it permits you to add something to an income. So in my understanding is 69C is a case wherein you have some funds which you have utilized for incurring expenditure, and you are unable to explain what is the source of that funds. Okay. Now, so it is this expenditure which can be added to your income. In the good old days, before the provision was added to 69C, it was also allowed as a deduction because it was otherwise considered to be an expenditure which was a business expenditure, and that is why it was allowed as a deduction. The legislature, realizing that this was a double whammy, it therefore provided that once we make an addition under 69C, we will never grant you a deduction. So 69C is a two-edged sword in which cuts assessee only and never revenue. So if you appreciate this, then in such cases, anything which is accounted in the books can never be hit by 69C. Can never be. Anything which is outside the books only can be hit. So in the end, as usual, I will apologize all of you for not having covered everything, but as believe me, that once I list 60 cases does not mean that I need to cover. What is important is that all those cases which we desire to cover, we have covered. 30 number of cases also is a good deal of cases, but the remaining 30 also are laying down important ratio, and I would advise you that please apply your mind to this. Yes. Thank you so much.
Thank you.
I said Pradip will get half century. We did not allow him to stay on pitch. But whatever he covered was excellent. Without piece of paper, speaking so much, is really in-depth knowledge he possesses. Before I request Dinesh Bhai, Vice President would like to say a few words because we are not present in the meeting.
Good.
Thank you, Ashok bhai. Because this was our first group meeting in this new term, and having this opening batsman by Pradip bhai is a good start for us. And in the first match he has hit the century vacancy because he has covered a large number of decisions. I can say only one thing about Pradip bhai, that he is a person who is always a friend, philosopher and guide. And whenever I have personally talked to him at any point of time, he always has been a source of inspiration and always has been a guiding star for us. And he always inspires for doing many things, and he is a person with full of ideas. And he always believed only one thing, that simple living, high thinking, which I learned many things from him because in the last couple of years interaction with him, though I interacted with him last few years, but last couple of years I had good interaction with him for many other things. He's always been a source of inspiration. With this few years, a lot of things could.
I think that's we are for the day. But I am not dedicated to Dr. Sivra on suspicious purchases at 4th of this business. Now I propose hearty vote of thanks on behalf of Chamber of Tax Consultants to CA Pradip Kapsi for masterly analysis with his vast knowledge and experience. The recent judgment on direct taxes, his selection of cases are superb. Today's discussion will help us lot. I especially thank him for sparing his valuable time in spite of his busy schedule. He shows his love for chamber and for sharing his knowledge and experience with us. Thank you very much, sir. I also propose Priti Shukla for explaining some Latin terms which are very useful for interpreting direct taxes. Thank you very much.